Good evening, everybody. We are so excited that you joined us tonight, and we're going to have some amazing information. This is the Wealth Builders Real Estate and Market Update webinar. I'm Karen Conrad. I'm the Vice President of Wealth Builders, and on behalf of Billy and Becky Epperhart, I want to welcome you and thank you for joining us tonight. We've got a power-packed session here, and I want to just give you a little heads up on some things, the way the process is going to work, and let you know too that Billy, he sends his apologies, but do you know what? He is not feeling well. Him and Becky both are not feeling well, and so he's not able to join us tonight. So I brought in the A team, I'll tell you what, and we are going to have some great information for you. And I want to let you know what you can expect on the webinar tonight. First of all, we're going to spend the first and the bulk of this webinar talking about 5 strategies that the team, the Wealth Builders team, has pulled together that we want to encourage you to take advantage of with these opportunities in the remainder of 2021 and into 2022. And then after that, we are going to go through a market update for about 10 to 15 minutes, and then we're going to finish the evening with a Q&A. And so let me just share with you who is on with us tonight. And so when I introduce you, if you could just say hi to everybody, I'd really appreciate it. First of all, we have got Bill Bronchek on, who is an amazing real estate attorney in the Colorado area.
Hello. Nice to have the opportunity to share some ideas on the market, which I've been doing for 30 years.
Awesome. Thanks, Bill. We've also got Mike Davis on, one of our real estate coaches.
Hi, all the way from Pueblo, Colorado. It's great to be with everybody, and I know it's going to be a blessing for everybody who tunes in. So we're looking forward to it, Karen.
Thank you, Mike. And we've got Frank Poley, another real estate investor and real estate coach for Wealth Builders.
Hey, everybody. We've got some great information for you tonight. Thanks for being here. And we're excited to share what we've got.
Thank you so much. And we've got a new face on tonight, David Straszewski, who is the CEO of Sound Planning Group. David, welcome.
Hey, pleasure to be here from the great Seattle area. Excited to be with you tonight and share some thoughts at a really important time in life.
Awesome. Thank you so much. And so let me just give you a little bit of an introduction to some things about Wealth Builders. Many of you might be new to Wealth Builders. And again, Billy and Becky Epperhart are our founders. And we are just so blessed to be part of Wealth Builders. And I think many of you that are partners and have joined us would agree with that. And if you want to learn more about Wealth Builders, the upcoming events, if you want to take advantage of some of the free blogs information, you can go to wealthbuilders.org and you can subscribe, and we'll make sure that we get updates to you. Also, I want to let you know that we've got Wealth Builders University, which is an online school for all things Wealth Builders. So that's something you can go to the website as well to check out. Billy has a podcast that we do every week, and you can search for Billy Epperhart, the Wealth Builders podcast. It's on Spotify, Apple, you name it, it's available for you. And we've got a real estate workshop that is coming up on October 15th through the 17th. It's an in-person workshop, which we're so excited about. We haven't been able to be in person for a long time. And again, that's October 15th through the 17th. You can go to wealthbuilders.org and register for that. You can attend in person, which is the best experience, or you can join us on live stream. And I've actually got a special code for you tonight that you can save $100, and that's Real Estate 21. Or for the live stream, you can enter Real Estate Live, and the team, the Wealth Builders team, will put that up into the chat section. So we want to interact with you. We will definitely be going through some things for about 45 minutes to give you some good information, as I shared at the beginning. But then we're reserving that last 15 minutes for live Q&A. And so here is what you can do. Post your question right here in the chat section, and the team is pulling that information together and they're pushing those questions to me. We'll answer as many as we can. And if you're joining us on Facebook tonight, welcome. You can just post your question right there in the comments section. And so let's go ahead and get started. Again, we're going to start out tonight talking about the 5 strategies for real estate that the team is recommending from 2021 and going into 2022. And the format that we'll use is I will actually go through this strategy, and I'm going to call on our experts to comment on it, and you're going to get a lot of great perspective on this and a lot of ideas. You know, we don't always agree on everything. We agree on sound principles, but it's really good to get some opinions in there, and we want to share that with you. I encourage you to take notes, and we're going to go ahead and get started. So our number 1 strategy that we want to share with you is to leverage the low interest rates and the appreciation. One of the challenges a lot of us face when we get into real estate is getting that cash to actually get into that property. And one of the things that many times we're not even aware of is we could be sitting on a large amount of appreciation that will help us to tap into money that we already have in our real estate to help us with that down payment. Now, I'm going to call on the panel to comment on this, but I want to share a slide first of all that gives you an idea of the low interest rate environment. Those of us that have been around for a while, I was in banking for 25 years before I kind of went into this real estate investing in this phase of my life. And so I've seen interest rates throughout that period of time. And the normal interest rate environment really is more around 6%. But today we are looking at interest rates more in that 3% range. And of course, that's going to vary a bit depending on the type of loan and credit that people have. But the point is that if you look at things from a historical perspective, we are in pretty much a record low interest rate environment. Also at the same time, I want to show you a graph on the existing home average sales prices. And this is something that shows also tremendous appreciation. Now this one is a tighter time frame, and I chose that to just show you that really since even 2019, look how much appreciation has happened in the market. And so on this topic of leveraging low interest rates and appreciation, I'm going to start out with Bill Bronchek commenting on that. And so Bill, give us some of your wisdom on how we can leverage and maybe why we should leverage the low interest rates and appreciation.
Great. Thanks, Karen. 2 good slides that really show the game here today in real estate. The reason that prices keep going up is supply and demand. It's a consistent demand for housing, and supply is very low compared to demand in just about every major market in this country. You know, some more than others, and real estate is local. You know, so what's happening in San Francisco and Detroit or in Tampa or in Houston are not all the same, except for the fact that they all share something in common: high demand, low supply. And that's what's pushing prices up. A lot of people are sitting on a lot of equity, and they might be thinking sell and get another house, but they realize, well, I got to pay full price for that house, even though I get full price for my house. So they're sitting on it and waiting to see what happens with the market. Now, in some markets in the future, you know, I don't think anything is going to change before the election next year, because the incumbent government always props up the economy to make themselves look good. And then after November, we'll see what happens. So I don't see any change over the next year. It's going to be continuing prices rising, low inventories, and so forth. At the same time, we have record low interest rates. And if you're in the rental property business, that's good news, because not only is your property going up in value, but so are your rents. Inflation pushes up rents. So with all this government spending and talk about $3.5 trillion of spending, it's going to force two things. Number one is you're going to have inflation, and inflation brings up rents. So that's good as a landlord. If you have a fixed low payment for 30 years at these record low numbers, you're going to do really well. Now, some people might be saying, well, I'm going to wait and see what happens maybe in 2022 or 3. Maybe I'll get a better deal on the price. Maybe, but will you get this interest rate? And if you look at how much you pay extra for a point or two in interest rate over 30 years versus, say, getting the property 10% or 15% cheaper, you might actually do better in the long run with the paying more but having a lower interest rate. Because it's cash flow, it's money in, money out. It's not, as a landlord, we're not looking strictly at appreciation, although it is an important factor. We're looking more at cash flow. So if we can lock in those low rates, and prices may fluctuate, they may go down and then back up again. But if you're in the long haul, which is 10 years or more for a rental property for retirement, it's hard to go wrong.
Wow, Bill, that is so great. I do hear people that are like, well, no, I mean, prices are so high. Maybe I should just sit here and wait for something to happen. And I really love how you just shared, like, hey, these interest rates are a tangible advantage that we have. Thank you so much. Mike Davis, I'm going to go to you next on this topic. Share with us your thoughts on leveraging those low interest rates and appreciation. And you actually have quite a story on your real estate where the values are today.
I really do. This is how I got started. I was talking to Billy Wayne on this, and he said, Mike, you know, you really ought to get into real estate. And I said, Billy, I at this particular time, I had $5,000 in my savings account. I said, I know I can't do anything with that. And then he said, well, how about your home? How much equity do you have in your home? I said, oh, I got a ton. In 2 years, it's going to be paid off. And so he said, Mike, he just started laughing. You can definitely do this. And so there's probably people out there who are thinking something like this. You know, I just don't have the cash available. Well, let me tell you this, it's not exact, but you can go to realtor.com, Zillow.com and get approximate of what your home is valued. If you have not done that in the last 6 months, you are going to be shocked, let me tell you, because prices are going up almost weekly, definitely monthly, they are going up. So with the low interest rates and the appreciation that's in your house, I'm telling you, there are a lot of people out there, Karen, who can do this, even though they say they don't have money in their savings account, they can do this. So that's pretty exciting.
That's awesome. And Frank, I'm going to go to you next, and then we'll go on to the next strategy. But one thing I was thinking, and you really help people with this, is how do we access that equity? How do we go about getting the cash out? What are some vehicles we can use? You're on mute, Frank.
I mean, you can get a HELOC on your property. I mean, in some cases, they'll allow you to cross collateralize it if you've got some other properties out there. I mean, you know, I think that's a really good way of getting cash out. And one thing that Bill mentioned too was, you know, there is inflation, but what's great about real estate is when inflation goes up, so do rents. And although it may not exactly follow, prices go up too in the long haul. And so if you want an investment that's pretty much going to keep up with inflation, that's the best one you can have.
Awesome. Thank you so much, Frank. And this next one, I'm going to start out just to give you a heads up. Bill, I'm going to start with you. And then David, I'm going to be going to you after Bill. And this next strategy is understand tax laws and plan accordingly. This is so important. We know that we're hearing almost daily in the news about how taxes are going to go up. But you know, when we're wise about it, when we get good counsel on it, there are things that we can do, particularly in real estate, to reduce our liability and plan accordingly. So, Bill, you are an expert in this area. So I'd love to hear what you have to say, some things that we can do about taxes.
Right. Usually when I talk about tax savings or taxes, people's eyes glaze over like it's a boring topic. But when I say, hey, how would you like to put more money in your pocket without working any harder? Then it's exciting. And the best way to put more money in your bank account is to avoid paying taxes at the rate that the average person pays, which is when you're working for an employer, there's nowhere for your money to hide. You're taxed at the rate that the government sets forth for your level of income. Now, having a business, particularly real estate, it gives you the ability to have deductions, gives you the ability to have, for example, depreciation. When you own rental property, you depreciate on paper the structure because it wears out. Now, we both know that real estate goes up in value, not necessarily down, even though on paper we're saying the structure, the building on the land is going down in value because of the fact that it has a useful life. So for paper purposes, you could have positive cash flow, but for tax purposes have negative cash flow. Why is that good? Because a negative number can be used to offset income you have from another job or business. So it gives you deductions with depreciation. If you're even flipping houses or doing other things, now you've got a business where you can start deducting things that you would pay for out of pocket with after-tax money. So, the thing I really want to impress upon people is the best time to talk about this is January 1st for the year ahead. Don't wait till April 14th for the year behind. Throw a shoebox at your accountant and say, hey, save me money. There's only so much they can do at that point. So you got to plan ahead and say, okay, maybe Congress might do this, maybe Congress might do that. Here are the existing laws. Here's what I plan to do, Mr. Tax Advisor. What do you think I should do?
Wow, Bill, that is great. And I need to be one of those that starts at January 1st. And you're definitely making me a believer in that. Plus, going back and tracking expenses from the previous year, no fun. We talk about that a lot. So thank you so much. And David, wow, David is so passionate about this topic. And when we visited earlier, he had all sorts of strategies and things for us to be aware of. Plus, he's got a lot of insight into what's coming ahead into tax law. So, David, again, we're really happy to have you. And please share with us some things that we should be leveraging and taking a look at as far as our taxes and real estate investing this year.
Absolutely. Well, if we don't already know it, taxes are on sale right now. Whether you like the idea or not, the passing of the Tax Cuts and Jobs Act went into place on January 2018. And though this changed the way that we were able to have certain deductions, the average American got an increase in their standard deductions, which is a really big deal. Additionally, our ordinary income brackets went lower. Now, if we understand, President Biden's agenda right now regarding taxes, you note that there's increases that are coming here in the future. And even beyond him, I've been saying this for years, that it doesn't matter who's president for the next 3 terms, with the amount of money that we're paying right now for Medicare and Social Security as a nation, exceeding 45% of all federal income. We have some challenges as baby boomers right now are aging into retirement at the rate of 10,000 people a day. So if you're not taking advantage right now of tax advantage planning, if you're not understanding how to do Roth conversions, not just contributions into Roth accounts, but conversions from IRA accounts into after-tax accounts, or tax-free accounts rather, that's something that you really need to be paying attention to. I'd say also with real estate, we understand, just as Bill just so eloquently put, real estate ends up becoming very good cash flow for us in retirement. It also can establish a foundation and a base as long as we can keep renters in there. I live in the greater Seattle area here, and so we've got some moratoriums and some different things. I know a lot of people have lost a ton of money in real estate rentals here just in this specific area, but my goodness, are there opportunities around the country right now to be capitalizing on sort of the inefficiencies that real estate has. Because see, real estate's a lagging indicator of economic health, not a leading indicator. So what happens is if we can begin to see trends going up in certain areas where we're seeing people migrate to, specifically 1%ers or folks that are, looking to downsize from their, more inner city type of a home to kind of getting to more of a suburban type of a situation. I think that's really where we're going to find a lot of opportunities for upside equity appreciation, and then also have great K1 schedules on those on the income.
Well, that's great. And David, I'm going to ask you to comment on two other things we were visiting about earlier. A 1031 exchange, if you can give a quick
Yeah.
overview what that is and why we should look at it. And also if you could touch on that real estate
Mhm.
designation.
So the 1031 exchange, and I'm sure Bill can do this one too. The point is that a lot of people have had highly appreciated real estate or rental properties here. So I'll just specifically say the greater Seattle area. I think we've actually led the nation in appreciation since 2010, which was where the bottom kind of was. So my advice to everyone, that all of our clients, is that we're talking about getting out of real estate here in the greater Seattle area. Well, people say, hey, if I do a 1031 exchange, sorry about that. If I do a 1031 exchange, then I got to buy a property in another location, and it's difficult to find something. I got 90 days to name it. And so one of the challenges is that, realtors aren't super familiar with this. And additionally, they're typically just in their own market. So one of the things that we love to do is capitalizing on inefficiencies. And so if you can sell from a place that was very efficient and made a ton of money, and you can go now to a market that's, undervalued today, and you've got high predictability of equity increases, you've got good cash flows that are coming through, then you're going to really find yourself excited about some of those investments. You mentioned the real estate designation, the professional designation. Very smart for people to be looking at this and considering this, even as they go into retirement. What a nice thing to be able to do, to have, things like your cell phone even as a write-off because you've got a business. But also we can fully deduct depreciation when we are a real estate investor. And so as we look at acquiring more properties, as we look at establishing true income flows for retirement or whatever you want to do with your life, we have the ability to find ourselves in a more efficient type of cash flow situation. I think Bill said it really well. We can be going up in reality, but depreciating on paper. So anytime that we can find an arbitrage like that and the tax code will support it, we certainly want to capitalize on it.
That's awesome. And Bill, I'm just going to come back to you for a moment too, because sometimes things like 1031 exchange, real estate designation, it can just sound really, really complicated. But I know that you help, and we'll talk about this a lot actually at the upcoming workshop. If you know what to do and who to connect with, those things are not difficult. So can you just comment on the process of the 1031 exchange, Bill, and then also on that real estate designation?
Right. So as David mentioned, an exchange is where you sell a property and buy a replacement, and then you defer paying taxes. And in some cases, you can maneuver it into a way that you can avoid paying most or all of the taxes at some point. The challenge is there's a time frame in which you have to identify the replacement property, and it's only 45 days from the time you sell the property. So in competitive bidding markets, it's very hard to get a property under contract in 45 days. Now, there are other ways to do it, which I'll talk about at the workshop. But one of the things is you don't have to wait until you sell your property to start looking for the replacement. You start looking, as soon as your property is under contract for sale. So it's not really 45 days. It's more like 2.5 to 3 months if you do it right.
Oh, that's so good. Thank you so much. All right. Wow. Great information. And the next strategy, this is number 3 that we are going to encourage you with, and we've touched on it, but we're going to go in a little deeper here, is to buy in the right markets and buy the right kind of real estate. And we've talked all around this already, that in markets like David was sharing in Seattle, people are selling there. It's at an all-time high. They're getting that money and they're buying in other markets where the real estate maybe hasn't taken off like that. And I think with the real estate market now, a lot of people think, oh my goodness, there's no opportunity. The prices is so high, and we're here to tell you there could be nothing further from the truth. As a matter of fact, everybody here is actively investing, and we are finding properties that hit all the ratios that we teach and train about at the real estate workshop. I want to show you one slide and then we'll go to the panel here. This slide is historical median monthly rents. And there are certain ratios that we want to hit when we look at properties. And there are some markets, we've already talked about New York and on the West Coast in Seattle or California, where the prices are so high, but the rental rates are not high enough to be able to move with the prices of the homes. So when you actually get in those markets that haven't hit that really high point and the rental rates are moving with it, when you lock in at that low interest rate environment, you've got a fixed cost for your funding, which we shared with you in number one strategy. And look at this, there's really no dips to speak of in the historical median monthly rents. It's like a straight shot up. And so I'm actually going to go right back to Bill because he's on for just a limited time here tonight. And Bill, I'd like you to comment on why you think the rental rates have just continued to go up, and if you think that they will actually continue with that trend going into next year and beyond. Oh, did Bill hop off? I think he did actually. Okay, we didn't catch him on that one. All right, so Frank, I'm actually going to go to you with that same question. If you could just comment on that.
Well, it's supply and demand. I mean, we have a big influx of people into our country and into our various states, and supply and demand dictates that, landlords could get a little more rent. And like I said before, it keeps pace or outpaces the economy and that sort of thing. So inflation. So I mean, I think that that's what we want to look at. Okay.
Mm-hmm. Yep, that's really good. And again, there's certain ratios that you follow. One of the things that Billy and Becky teach us that's helped all of us tremendously is that there are guidelines that you follow. There's 4 or 5 things that you learn in the workshop that you want to follow these guidelines, and you don't want to go beyond that. We've touched on that a little bit too. In some markets, appreciation is definitely there, but you don't want to put all your eggs in the appreciation basket. You want to look at cash flow, you want to look at some other things, but with a low interest rate environment, you can see where once you lock in and those rental rates continue to climb, your cash flow is going to continue to go with it. So Mike Davis, I'm going to go to you next, and if you could just comment on this too, like how do people find the right markets to buy in? What are some tips that you can share?
I like to look at it, it's like a safety net for you. There's not too many things that you can invest in and buy and say, there's not too much of a safety net for you. But when it comes to real estate, we'll talk, like you said, more about this in the real estate workshop. But if you stay within the parameters, find out what the median income is for the area that you're looking to purchase in. So you want to stay 2 to 4 times the median income for the price of the house that you're going to buy. In 2006, I believe Las Vegas went up 14 times the median income for property in Las Vegas. Well, you are going to really lose when that starts to come back down. So over the last 75 years, Karen, the housing market has been 2 to 4 times. And so if you purchase property within 2 to 4 times the median income, you're going to be buying the right house, no matter what market that in, no matter what city that you're looking at to get, you stay within the 2 to 4 times. And the good news is that's not difficult to find. You can Google the median income of just about any town in the United States. And so if you stick with that, and then when you have to find out from somebody who knows the property in that area, what the most important question Billy always says is not how much that house is, but how much will that house rent for? And you find out how much it rents for before you purchase that property. So we are looking at 1%. So if it's a $100,000 house, you want that house to rent for $1,000, for $200,000, $2,000. And so those are 2 great safety nets that can keep you safe no matter what market you're looking to buy in.
That's awesome. And there's other parameters to look at too. And we actually have some ways that you can tweak those numbers a little bit. But I teach a session on how to go and research. So I literally take you hands on. We're going to go out to Zillow, to realtor.com, and I show you how to locate those markets right from your living room in your fuzzy slippers with a cup of coffee, right? You don't have to drive out all over the United States. There's ways to research it. And so that's one of the things that you'll be learning in October. All right, David, I'm going to come to you on this one. Because the right markets are really key, and you're in a market that we might say might be the wrong market to buy, but also you know how to look for those right markets. And then also, will you comment on the types of real estate that we need to be pursuing right now, and which areas that we might want to avoid?
Yeah, really good question right there. So let me just start with the right real estate versus the wrong real estate. So a couple economic factors that we're seeing right now is this low interest rate environment, and it should likely continue and persist. One of the challenges, though, is that we have had pretty significant shutdowns under the COVID world, and a lot of small businesses, specifically service businesses, had a ton of their liquidity disappear. And additionally, people are starting to consume differently than before. One of the things that we're recognizing is that commercial real estate is going to have some challenges here as time continues to go on, specifically in cities that have locked down harder, that may even like Seattle right now, for whatever reason, our governor is requiring immunization passports to go into local restaurants right now. And so this is the death knell to so many of these restaurants and whatnot that, you know, I've personally been trying to support and keep going and all this stuff. But as we are going more online in the services that we're looking for, and just the simplicity of our smartphones, we're seeing the consuming begin to change. I think also in you know, since 2020, you know, we're all thinking about our health a little bit differently. And so, you know, 65 people climbing on an elevator and going up to the 50th floor of a building is not as likely to be happening, where people want to do more like what you were talking about, sit with their fuzzy slippers and a cup of coffee and be, you know, cranking from home. So I feel like there's some challenges, and specifically REITs or these conglomerates of groups of real estate are an area that we need to be really, really, really cautious about. See, we can talk about all the trends of real estate, but we need to understand where the right opportunities are. So I'm bullish on residential real estate, because families are looking at, you know, getting closer and having more quality time at home. Perhaps working from home is a real solution today. And a lot of employers, including myself, I was not even open to that idea previous to 2020. And now, you know, we've got several people that are doing that. We've got a few positions that are permanently that way. So I think that it's important for us to understand, you know, what we're looking for, what we're not looking for. I love the idea of getting the metrics of what we're looking for and when we invest. So yes, it's going to take us, you know, having a revelation for the cities and states that we're looking to purchase, buy, and be a part of. You know, a challenge though is doing things, you know, away from your primary residence or your home. And so these are things that you're going to be teaching about, and you guys can certainly share as far as, you know, how to build a realtor team and have contractors and be able to manage these things from a distance. But I think a lot of people get into the life and they go, okay, well, this sounds great, but how do I do it? And then they get this paralysis by analysis, and they don't really pull the trigger, and then more and more time is going by here. So we're looking for areas where people are moving into, as opposed to moving away from. So where's the tide coming in versus going out? Again, it's very easy to see these demographic changes. I think that we're going to really find some interesting things as tax returns come forward in 2022 and then also 2023, seeing who moved. As an example, 1%ers, middle class, and you know, decentralizing from some of these areas that they were before. So doesn't mean that there's not opportunities in commercial or whatever. It's just that it is not quite the same thing that it was previously, and could actually be a time bomb, because we could see the supply and demand. You know, when the sellers want to sell more than the buyers want to buy, the price goes down. And so look where the buyers want to buy more than the sellers want to sell. That's where we're going to find the opportunity.
Wow, David, that's awesome. Thank you so much. All right,
Mhm.
strategy number four. And I've experienced this recently, actually, and many of us have too. And Frank, I'm going to pitch to you on this, but landlords that are ready to get out. As much as we know there's a lot of opportunity, we are also seeing that this is a season where some landlords are just like, you know what? This is a great time for me to exit. And so, Frank, can you comment on that?
Yeah, well, it's a number of things. First, we've got the aging of America, and you've got people that have been landlords for a long time, but they just don't want to do it anymore. Some of these people have a lot of properties, but most of them have less than 10. And so, a lot of times they'll sell them maybe as a bundle, give you a little bit of a discount, but you also probably have some tenants in them, which is actually not a bad thing unless they've got a
Mhm.
long-term lease at a cheap rate. All right. So you've got that. And then you've also got landlords that, are tired of the COVID thing and, tenants not paying. Although I will tell you, that's not as bad as the media makes it sound. Most of us that have had properties, like Bill Bronchick, he's got hundreds of properties. He had about 98 or 99% pay rate. So it's not as bad. But people just get tired of the struggle, and so they want to get out. And so there's where you can make some good money by maybe buying a property at a discount price or two or three at once, and that can be a good strategy.
Yeah, I think too, something else that is causing people to look at that is the tax things that we've been talking about, like where the taxes are going. If people sell now, they have an idea of what their tax liability is going to be. Who knows what's going to happen over the next few years? So, why not get out when you kind of know what's happening and properties are at their highest? Mike, if you could just share with us, what are a couple ways that people can actually find these landlords that are probably ready to get out and ready to sell?
Well, a lot of you can even go on Craigslist and find out for sale by owner. Some of those, if you got it, we teach this in the real estate workshop and having the right team. And if you have a great realtor who knows investment property, I'm telling you, they're in the know. They know the ones like what Frank was talking about that may own 5 or 10, 20 or 30. And if I could piggyback on what Frank was saying, which was great information, Frank, and that is this: if you do find somebody with 5 or 10 or more, they're not going to probably say, okay, go get a loan and pay me, $500,000 for this package of all of these rentals that I have. No, because the capital gains tax will be so enormous, it will eat his lunch. So he will probably want to do something about owner financing. And boy, that is a dream come true for people who maybe not have a lot of cash. If you can find somebody like that will do owner financing, and then voila, you have not just one or two that you were looking for, you may have 10, 15, or 20 that the guy is willing to do owner financing. So there's great opportunities out there for something like that, because I'm with Frank. There's a lot of people getting out of the property management and owning properties. They're just saying, you know what, I'm done with this, and I think it's time to sell.
That is so great. And one of the ways that we're looking at some properties right now, we got the lead from our property manager. If they're managing your property, they're managing other people's property too. So pick up the phone and say, hey, are you aware of anybody that's trying to sell? And I can't believe this, Mike. I don't think you did this on purpose, but what a great segue into our fifth strategy, which is creative financing and
Yes.
foreclosures. And so I think that was really good. You just shared one with us, owner occupied, or I'm sorry, owner financing for people that really are trying to avoid those capital gains. I'm going to share a couple graphs with you on foreclosures, and then I'm going to go back to the panel to comment on this. Creative financing is something that we hear a lot about. Pretty much everybody that invests in real estate has to look at some alternative outside of Fannie and Freddie. to get where we want to go. But one of the looming things is the pending potential of foreclosures. And I'm going to be getting some input from the team on this. I'll start with David initially on this, but let me show you this graph. And this is from the MBA, the Mortgage Bankers Association. And in this, this is mortgage delinquencies, actually, before we go to new foreclosures. This is really interesting because as much talk as we have right now about pending foreclosures, if you look at the delinquency rate, now keep in mind a delinquency rate is not going to include properties that actually moved into foreclosure, and that will be on the next slide. But we've actually seen a significant drop in delinquencies as we have gone into 2021. And so I'm going to have people comment on that a bit, but I'll show you the second slide next. And this is new foreclosures that are percentage of new foreclosures and a change. And again, look at this. It's actually extremely low, even looking back to 2019. And so this just doesn't make a lot of sense with what we're hearing as potential foreclosures that are coming in the market. And so, David, if I could start with you on this, can you help us understand, is there foreclosures coming? Is there not? What's happening here?
Yeah, really great question. I feel that part of the answer is that the Fed has been very accommodative to the entirety of what's happened under COVID. And so, as a nation, we went from 22 trillion, it took us 230 years to get to up to 2019. And then now we've added essentially another 8. And so that's a big deal. So the Fed has ultimately kind of propped up the market and has given extensions for those who were laid off and tried to accommodate some of these things. So will foreclosures change in the future? My opinion is, yeah, they are for sure going to come. Because I see the world changing, and there's certain industries that are out there right now that are going to probably lose a lot of jobs because things are going more towards technology. There are a lot of challenges out there. So it's only when people really lose everything that the foreclosures start to happen. And so as long as the Fed continues to be accommodative, now how long they can do that for, I don't know, because many of us have been looking at this for a long time saying, how can they go even more? How could they go even more? But so anyway, there's a great opportunity there though for, I love that idea of purchasing from someone that is looking to get out of their property and helping to avoid some of the capital gains through longer duration payments and getting creative in some of that. But yeah, there definitely are foreclosures occurring depending on the cities and the places. And I think that there's going to be more of those coming, but we might be 2 or 3 years out because they take time for defaults to occur. The banks try to reconcile the debt. They try to, load back those payments that didn't occur into the back of a loan. And so they've got some cash to be able to do some things with. So I wouldn't be looking at foreclosures as like a super hot idea at this moment. Plus, there's a ton of people that are looking for them. Back in 2010, I was advising our clients when no one was looking for them to go in. And I mean, we were buying properties for sometimes as low as 20,000 in the 50,000 ranges. And, we've 10x'd on those properties since that point in time. But those really, really amazing opportunities are few and far between.
Great. Thank you so much. That brings a lot of understanding to it. And this really leads right back to you, Frank. I'm going to come to you next because we were having a conversation today about, those foreclosures aren't necessarily going to hit. And when they do, there'll definitely be a lot of people looking to them. But you were giving us an idea of how to write a contract for someone that might be kind of before that foreclosure point and trying to avoid that process. Can you share with us? And this is on our creative financing.
Yeah, absolutely. I mean, the trick is not to wait till somebody is in the foreclosure process. In other words, the official letter, we call it notice of demand or notice of election and demand in different states, comes out from your county assessor, or your county treasurer, whoever does that in your state. It's before that. And a lot of times once somebody is late on payments for a little while, um, the lender will send several letters of warning, and that's where you want to catch people, because you know some of these people are behind and they may never make it up, but some of these are difference in foreclosures this time rather than in 2010. And I was in that mess too with everybody. We did a lot of foreclosure work with people, is that some of these foreclosures may actually have a little equity in them. And there are several creative financing techniques. I think Bill Bronchick's going to talk about those at the workshop, where you can get into these for not a lot of cash and no closing costs. And it doesn't go against your bank, your credit. I mean, there's some big advantages for doing that. The other thing I think is I agree that they're going to trickle out, the lenders will. They're working with people right now, and they did not work with people in 2010 and beyond. But the thing that the lenders did in 2010 is they just put them all back on the market at once, and it just further tanked the prices. I think the lenders learned their lesson. I think they're going to go ahead and put them out in little bits so our market still stays robust.
That's great, Frank. Yeah, I was in, as I mentioned, in banking for 25 years, and boy, do I remember that period of time and what happened. And you're right, they flooded the market with it, and there was no demand, which just further caused the problem. So it's definitely an opportunity for us to take a look at. I love the perspective that the team has shared. We are getting so many great questions, and now we're going to take a few minutes. And David Strzezuski, again, he is the CEO of the Sound Planning Group. He was actually named the 2016 Advisor of the Year by the Society of National Security Advisors because he has such a strong knowledge in the things that we've been talking about. So we're just really honored to have you here, David. And I know I've asked you to keep this pretty concise because of our time, but David's going to share with us about 5 strategies that he thinks that we should be looking at during this time of finishing 2021, 2022, and then we are going to answer a few questions, as many as possible. So David?
All right. Well, thank you so much for the opportunity to be here. So here are just a couple of economic overviews. Karen, I think you did a great job facilitating our time today and really gearing the 5 points that you made towards the things that are very relevant to all of us right now. I really want to draw attention to that first slide that you showed us. The first slide that you showed us was the interest rates that were going down since September 1st, 1981. So if you didn't know it, we just had an anniversary here of 40 years since the interest rates have been dropping. Now, a lot of people would look at that and they'd say, wow, that's really interesting. So here's a couple of economic factors that are important for us to understand. Now, number one, I'm a math and science guy. And so anything that I'm going to be sharing with you is going to be geared based upon math, science, and real ideas behind them. So a couple of things that have happened over this time frame that are very important for us to understand here, 2021, is that, you know, when interest rates go down, what that does is it allows us to borrow more with the same median income. So one of the reasons that we've seen such high price appreciation in real estate over the last 40 years is because ultimately our same median income had the ability to buy more home, and then the supply and demand factor kind of comes into play. So when you want to get into an area and you're able to leverage a little bit more because interest rates went down from, you know, people probably on this call remember, you know, paying, 17, 18, 19% back in the early 80s for their first home, you know, and getting it for $75,000. And then when interest rates go down to 15%, 12%, 10%, you know, obviously what we're seeing is just an escalation in the price. And so I think one of the new slaveries that is going on right now is debt. And what we're going to see as we're going forward is that people are going to have a harder time paying debt if they don't have the same income coming through, including countries, including states, including cities. And so this is something that's really important for us to understand. Now, my personal opinion is I see the Fed continuing to accommodate, and if we have a major recession, probably going down to a 0 interest rate level. And just like Germany, Japan, others have essentially done. So I think that we're going to stay low for a while. I don't know why they would raise them up. It would be very counterintuitive and something very different than the Keynesian economists who are running the Federal Reserve have ultimately sort of been marching to. But to go back to your slide again, so it works kind of like a seesaw. So when interest rates go, I'll just say this is interest rates, and here's the value. When interest rates are going down, the value of our real estate goes up. Well, what's happened also is that inside of our portfolios, which is what I primarily do, bonds are the quote unquote safe place for us to be putting money inside of our portfolios. And I want to bring a real strong word of caution right now. And that is, we need to understand where we are in history, and we need to know where we've been in order to appreciate where we are and have an idea of what the outcomes might be. And so what's happened in the same way with real estate, when interest rates go down, the value of the bonds goes up, the seesaw effect here. The same thing has been true with bonds. So when the interest rates drop, the value of our bonds go up. Why? Because let's say that you had a bond that was paying 15% back in 1981, and then interest rates go down, and now the new ones only pay 12%. What that's saying is your cash that you're getting for that investment has been reduced with new purchases. So there's an equation called net present value. Don't worry about that. Just understand that there's a seesaw. Okay. So we find ourselves at the bottom of an interest rate cycle. We don't really have any more room to go down. And so I think it's very important for us to understand that bonds have worked out really, really well to protect and hedge and do some of these things. I'm very concerned about them. There's 5 ways that we lose money in bonds. This is not commonly understood information. The first one I just mentioned, if interest rates rise, then the value of our bonds go down. This is supposed to be the safe part of our portfolio. And so if you have 30-year bonds as an example, and the interest rate goes up 1%, then you lost 30% in your bond. If you have a 10% bond, then you just lost 10%, just because interest rates went up 1%. So if we have interest rates rising, bonds are not going to save money. They're going to actually be losing money. If interest rates stay level right now, and we have this long-term duration, this is important for us to know, because right now bonds yield less than inflation. So you're actually guaranteed to be losing to inflation if we remain in bonds right now. So I would call that losing. That's the second way. The third way that happens is when we actually get into like real market crises. The bonds and stocks are supply and demand. They're priced based upon supply and demand. So think about it like this: if you want to sell, someone else has to buy, and they have to be willing to buy. So if the sellers want to sell at the same time, like we were talking about just a second ago with all those mortgages that hit the market in 2009 and 2010. Well, if the sellers want to sell more than the buyers want to buy, the risk that's there causes the price to just depreciate. And so bonds will actually go down relative to their trading price as well. So that's a third way. The fourth and fifth metric that bonds have as a challenge to them is creditworthiness. And so right now, as we are looking at the economy, post-COVID, there's a lot of changes that are taking place. I'll even wager to say that we've got industries that are very likely getting disrupted and just changing. You know, the travel industry is an example. People are not flying and traveling in the same way. And if you've flown recently and you understand that it's not, as exciting, happy, and fun as it once was, in at least right now, and people are doing more social distancing, et cetera, et cetera. So there's some changes that are occurring, but the creditworthiness. So if a bond, which by the way is debt, so when a company doesn't want to give away more equity or ownership for stock, that's what stocks are, is ownership in a company. Bonds are actually debt. And so let's say that you've got an A-rated organization today, it's investment quality, and they're having a harder time financially right now, keeping the doors open because they lost a lot of liquidity being closed, and the services that, someone doesn't come in and buy, 5 haircuts all at once, they get 1 haircut all at once, and so there's money that was lost through some of those time frames. Well, let's just say that you go from A-rated to now B-rated. Now, what you've done is you've gone from institutional level to junk bond level. Therefore, your risk is higher for default. And so that prices in with your bond, and ultimately there's losses that occur with this. And additionally, for those that went through 2008 and invested in companies like even Washington Mutual, Enron, Lehman Brothers, you know that those bonds went to zero and you got no return. So 5 specific areas to be cautionary about with bonds in the quote unquote protection portfolio.
Just a couple more minutes, David, so we get to the questions and answers. So this is really good stuff. I wish I had more time for you, but keep going and give
Okay,
us some strategies.
sure, no problem. So ultimately, where we are right now in history is that supply and demand is really important. We've got supply chain changes that have occurred, and so it's actually more expensive to buy or build houses right now than to buy homes that have already been built. And so that's a part of the reason why I think that we're seeing prices increase as well, because the cost of lumber, as an example, has like tripled. Now they're going to get some of that figured out, and some of that's going to balance here, and we'll continue to build. But contractors are of course very busy, and we've got a number of things that are kind of going on here. I can leave some of this available for the Q&A side. I think you did a really good job, though, kind of going through some of the important things that have changed. But I just want to bring three things back, just full circle on your first slide. So interest rates went down, and the value of our homes went up significantly because of interest rate fluctuation. Bonds went up. Now they're in a bubble. And then ultimately, this has propped the stock market up at record highs. Now we're seeing some tapering take place. We're seeing a little bit of downturn right now. The last point to this is that no one knows when the market's going to drop. No one knows how far it's going to drop, or how long it's going to be down. And so the point is that we have to have strategies in place that are dynamic and evaluating things on a regular basis, so that we're not just here left behind on some areas just because the world's moving and things are changing. So there you go.
Wow. Awesome. Wow, such great information. I wish we had like 2 hours. This is so power packed, but just to remind everybody, come to the real estate workshop. We're going to be sharing some great information so you can get more details. Also, I want to let you know we do have another free webinar that is scheduled. I believe it's October 13th, and Billy will be on. I'm sure he'll be back to, his normal health by then. But this has just been terrific. We have so many questions. So I'm going to ask the panel as many questions as I can here, but here's what I'm going to commit to you as an audience for staying with us. We will get these questions answered between this week or next week, getting them out in blogs. Somehow we will get this information to you and answer as many as we can. So I want to thank you for your amazing participation. So let's start with this one. And David, this will have to be kind of a quick answer, maybe just a yes and no and a comment. But Haley is wondering if now is a good time to invest in dividend stocks.
Dividend stocks are all right. That's an alternative to a bond because there's yield that's coming out of it. Ultimately, where are you going to go if bonds aren't a good place to invest? I would say that dividends have an opportunity in specific areas as well. I think we want to be more focused investing right now, as opposed to just allocation and buying everything, just because there's going to be changes here in the global thing, but specific areas are better than others.
Awesome. And Candy Bourne has this question, and Candy, I'll take this one. Is a HELOC better than doing a refi and pulling cash out? And you know what? It could be a right answer either way, depending on your situation. So what we've been advising people is that if you have the ability to deploy that money into real estate investments, purchasing another home, you're never probably going to see interest rates at a 30-year fixed as low as they are today. So we are personally definitely looking into that for money that we know we can deploy in investing in real estate. However, if you need a line of credit, for example, maybe you're doing flips or improvements, and maybe you're doing a BRRRR, which we'll be talking about more at the real estate workshop as well, where you need that money for a period of time, but then you have an exit plan where you will pay that off. That's where HELOC may come into play. But the thing about HELOCs is that you have to really watch those. They're usually variable rate or fixed for a very short period of time. And they are not an instrument, in my opinion, that you want to leave a balance on for a long period of time. So hopefully that's helpful for you. All right. And then Jonathan Glasgow says this, and Frank, this is coming your way. He said, my wife and I sold our primary house this summer. We're renting, but sitting on the profits. We'd like to potentially buy 2 homes, one for primary residence and one for renting. What are a couple things to consider while moving in this market?
Well, I mean, first of all, your primary home, you just wanted a location that's convenient for you that you like. A rental property, on the other hand, needs to be in an area that it makes sense. And we're going to be talking a lot about that at the workshop. But what makes sense is you get a return on your investment. And you may have to go, instead of the major cities, just the little outlying areas where people, are buying now and the prices are lower and the demand for rents is really good.
Awesome. Thank you so much. All right, Mike Davis, this is coming your way. This is a great question because we just talked about this with one of our coaching clients this week. This is from Susan Brunk, who's joined us on Facebook. RV parks are going up everywhere in Texas, and when you drive by them, they look full. Would this be a good investment, even though you're buying just the land and adding park sites?
Well, it depends on the legalities of the state. Where we found out here in Colorado that if you do not own the actual mobile home, then you don't have the same rights as a person who does own the mobile home. So if you have an mobile home park and you actually own the mobile home, you know what? Let me clarify something. Are they talking about mobile homes or actually just RV, like for camping? Is that what they're talking about?
They said RV park, but I think it's okay to talk about both of them because
Okay.
a lot of times you see a mixture.
Okay. Well, the mobile homes, you want to be the owner of the actual mobile home. Of course, if it's an RV park, I found out, I know someone who purchased an RV park that just is for camping. I think it was like 1.7 or 2 million. And now it's he's selling it for over 3 million, and he just has owned it for like 3 years. So the appreciation for those things are up just like they are for the housing industry. So the great thing about an RV park though is you don't really have a lot of high maintenance on those. The people take care of their own RV and everything. So if you can find out the cash flow, it's all about cash flow, Karen. When they put the money or start doing the bottom line, will this cash flow? And I think that's a hot item. And I think RV parks are here to stay because I think they're going to be continually growing. America has woken up to let's get out and let's travel and let's take vacation. So I think RV parks are going to be great.
That is awesome. Thank you so much. Wow, we've got some a lot of great questions. This has been such a great webinar, you guys. Thank you so much. I just want to remind everybody that you can connect with us at wealthbuilders.org. On Facebook, Billy's got an amazing blog, his YouTube channel, his podcast. And actually, one of the podcasts he likes to do is we send these questions to him and he'll answer questions in a podcast. So I'm going to plant that seed that we take these questions and he can deliver those in the podcast. But also, we do jump on Facebook Lives. You can email us at info@wealthbuilders.org. We are here to help you to build wealth God's way. That is the purpose. And that's why Billy and Becky started Wealth Builders. So again, if you want to join us for the October real estate, use the code real estate 21 for the live event. It's oh my goodness, 24 sessions in 3 days. It's amazing. We do something too it's not speed dating, it's speed coaching. So we all meet with you for spurts of 3 minutes and we do roundtables. It's just a lot of fun. So I'd love if you joined us live there. And then if you want to join us on live stream, it's a really, really great experience as well. Go to wealthbuilders.org and use the code real estate live. So thank you so much. I want to thank our amazing panelists and coaches. You're all such a blessing. And again, on behalf of Billy and Becky Epperhart, thank you so much for joining us. God bless you, and we'll see you next time. And I believe it's on October 13th for the next free webinar. Good night, everybody.